it was just a matter of time before the market had to address it. And I think the bond market has really been hit a lot harder overall when you look at it. And it was just a matter of time before the equity market had to recognize the fact that indeed interest rates are, at least those that are attributed to the market, the way the market prices yields, and the 10-year in particular, are rising in anticipation of an economic recovery that likely is to bring a waft of inflation, at least initially. We think the fear of inflation is overblown. It's not common. It's not uncommon, pardon me. It's not uncommon for the bond market to overreact to rising interest rates when the economy is coming back. We saw that, in 2018, the market was misdirected, thinking yields were going to rise and rise. In the first half of that year, they hit 3.11%. Second half, they hit 3.25%. And then the bond market discovered that actually yields were fabulous based on the fact that there wasn't enough inflation to justify a 3.25% yield. This time a bit different because we're coming from extremely low yields. Last year, we were at that 0.50, as I recall, in the 10-year treasury at one point. So when you look at it here, going to 1.5, moving in that range, you're looking at a significant percentage gain, but money is still very cheap and not likely to really hurt corporates that much.
Interesting point then. Then do you believe that 1.6% that we touched in that intraday spike on the 10-year benchmark is the peak of the overreaction?
I believe it certainly is at this point. I believe that's where it's headed to settle at some point, likely this year if we get a global economic recovery on back of a stateside resurgence as the vaccines of efficacy take a toll on the spread of COVID-19 and even address the variants as well. I think things are actually getting better even as they remain challenging, but that's life as well as the markets.
Of course, John, everyone's trying to work out just how much of a pullback this is going to be, whether or not it's just a quick, short, sharp, okay, we're done and dusted, or whether it's going to be something a little bit more prolonged. While the sentiment indicators haven't shown too many bears, they are out there, and there are also some skeptics who've been waiting for this pullback. How do you use it to your advantage?
Well, Mandy, we'd have to say that skeptics, bears, and nervous players are very grateful for a pullback like this because it allows them to take profits without FOMO, or fear of missing out. And that's a big deal. Fear of missing out is what drives the markets higher on a day-to-day basis when you get a bull run within a bull market. And we've had that considerably in the first 2 months of the year. And so now there's a pause of thought. The market's got to get a handle on itself and recognize that inflation does not look like it's going to peg high enough near term to justify the 10-year yield going to much more than this 1.6%. Though, believe me, I understand. I've been in this business for almost 38 years now. The bond market can overshoot to the negative as well as to the positive. So stay tuned on that one.